Good morning, everybody, and welcome to our Banking Supervision press conference on the results of the 2022 Supervisory Review and Evaluation process. With me are the Chair of the Supervisory Board, Andrea Enria, and the Vice Chair, Frank Elderson. The report with the detailed results and the list of the Pillar 2 requirements are posted on our website, and Mr. Enria will make an introductory presentation, which will also be posted on our website. So following his presentation, we will take your questions. So without further ado, let me turn over to Mr. Enria, please.
Thank you very much, Connie, and good morning to all of you. Thanks for being here or connected. Before I start, let me express our condolences for the people who have been affected and lost loved ones in the terrible earthquake in Turkey and Syria. The images we've been seeing have been with us for the whole day yesterday and today. So. Anyway, turning to more mundane things, today we are publishing the results of our annual supervisory review and evaluation process, the SREP, on the banks that are directly supervised by the ECB. In a year marked by the macrofinancial and geopolitical fallout from the Russian war of aggression in Ukraine, with persistently high level of inflation and rapidly normalizing monetary policy conditions, significant banks saw their profitability boosted by interest rate margins not seen for more than a decade. Yesterday night, I was looking at an internal note on the, let's say, pro forma profits that the banks, the listed banks under our supervision posted for the end of the year, still preliminary, of course, but it is basically the first time in many years that we see the aggregate return on equity entering into a double-digit territory, so which is really important news. The capital and liquidity position of these banks also remained very solid, and asset quality kept improving. The overall SREP assessment is broadly similar to the one of last year, and while taking into account the positive performance of the banking sector in 2022, the supervisory stance reflects some persistent concerns about banks' governance and internal controls. Deficiencies in these areas have become more concerning in light of the pronounced uncertainty over the energy crisis and the macroeconomic outlook, as well as the pressure from interest rate normalization, which could materialize in some bank portfolios, business lines, and financial markets. In my remarks, I will first look at the positive performance of the banking sector in 2022. I will then explain the factors that weigh negatively on our overall assessment, and finally, I will go into more detail about specific areas of supervisory attention. Overall, significant banks continue to maintain solid capital and liquidity positions. Their average common equity tier 1 ratio remains slightly below 15%, only marginally lower than the year before, and the liquidity coverage ratio continued to be high at 162% on average. Almost all significant banks reported CET1 ratios above new requirements and guidance. In 2021, we had 6 banks that were actually dipping into the supervisory buffer, so they were using the Pillar 2 guidance that we released during the pandemic. At the end of September 2022, only 1 bank was still slightly below the Pillar 2 guidance. Asset quality kept improving in 2022. The volume of non-performing exposures, NPE, held by significant banks dropped to 350 billion by the end of September 2022, and reaching a new low in terms of NPE ratio of 1.8%, the lowest levels since statistics on significant banks were published first in 2015. The bank's cost of risk had a slight uptick in the first quarter of 2022 due to provisioning to cover exposures towards Russian or Ukrainian counterparts, but then started going down again and reached pre-pandemic levels. So far, no tangible credit risk has materialized as a result of the war-induced macroeconomic shock, although there are some signs of latent risk. Despite the shock, banks' expectations on asset quality remain positive. At the core of banks' positive performance in 2022 lies the interest rate normalization process and the boost that this long-awaited shift provides to net interest income. So not only driving, let's say, the volumes of interest income, but also an increase for the first time in the interest margin, the net interest margins. 2022 also saw a slight improvement in banks' cost efficiency, with the average cost to income falling to just over 61%. And overall, these main driving factors pushed the bank's average return on equity at the end of the third quarter last year at 7.6%, which is, again, the highest profitability level since the start of the banking union. Banks analysts alike expect the profitability outlook to remain equally positive this year, in 2023. And this is also our central forecast, but adverse scenarios and differentiated implications across banks require close attention. For specific portfolios or business lines, of course, the impact of higher interest rates on asset quality could outweigh the positive effects on interest margins. and asset and liability management strategies excessively focused on carry trade may prove incompatible with the new monetary policy environment. Overall, the interest rate adjustment path may create winners and losers. In 2022, more than 90% of the significant banks received the same overall SREP score as in 2021, so there was a good stability in scores. There is a slight improvement with a few banks moving from the score 4, which is the worst, to the score 3, but all in all, it was basically stable. We also introduced and published for the first time what we call the qualifier score, so the 2 plus and minus and 3 plus and minus, that will give a little bit more granularity to the assessment. So next year, we will see probably more movement and we can comment more the development in scores. The weighted average of overall capital requirements and guidance increased slightly to 15%, 29 basis points higher than the previous year, and this was driven mainly by the increase in macroprudential requirements in some participating member states, so raised by national macroprudential authorities. The average Pillar 2 requirements decided by the ECB banking supervision remained fundamentally stable, 2% of risk-weighted assets. It was 1.9% last year. Given that no capital stress test was performed on the banks in 2022, Pillar 2 guidance remained unchanged compared to 2021 at 1.3%. Considering all these developments together, bank profitability has seen a marked improvement, NPEs at record low levels, and banks having solid capital and liquidity positions. One might ask, why didn't the bank scores, the SREP scores, changed compared to the previous year? And the key factor pulling downward pressure on supervisory assessment, on the supervisory stance, is the persistent weakness of internal controls. We found controls in deficiencies in risk control system, number of findings on the effectiveness of management bodies, in risk management, in compliance, in internal audit functions. We focus a lot also on difficulties in the IT landscapes and in risk data aggregation capabilities, which we deem very important for risk management. So our concerns about banks' risk controls and governance are, of course, very important in a highly uncertain economic environment, because the backward-looking indicators on the level of risks might provide less information rather than the actual strength of the risk control mechanism that would enable banks to witness potential headwinds going forward. The euro area economic outlook deteriorated during 2022, and banks now face a period of lower growth and possible recession with persistently high inflation and significant uncertainty over energy supplies. While rising interest rates are boosting bank profitability right now, they may also affect the ability of customers across a number of portfolios or business lines to pay back their debts, then translating into a potential threat for asset quality. Consumer lending, real estate lending, residential also, commercial and residential, and leverage finance are definitely area of supervisory focus in that respect. And then there is also the issue of, let's say, potential dislocations in financial markets. We have seen Archegos in 2021. We have seen stress episodes on energy derivatives clearing in last year, and the same the UK market for liability-driven investment. So the focus is also on concentrated exposures that some banks may have towards certain corporates or highly leveraged non-bank financial institutions. So banks need also to prepare for potential adverse impacts of this uncertain environment on their business, which may materialize as a result of interest rates getting higher faster than currently expected, or economic activity experiencing a sharper downturn than currently expected. Some signs of latent risk are there, highlighting the need for a prudent approach to risk management and provisioning. Although headline NPE figures continue to improve, bad loans have started to increase in specific portfolios, consumer finance, for instance. And also the dynamic of underperforming loans, the so-called stage 2 loans in IFRS accounting jargon, started increasing in 2022 and need to be further monitored. Importantly, the assessment of the credit risk outlook at this point should not simply assume that the recent past can be a good guide for future trends, for one main reason. The extraordinary monetary support measures and the massive blanket fiscal assistance to households, small businesses and corporates that brought to the record low level in defaults during the pandemic can no longer be expected given the persistent inflationary pressures. With monetary policy normalizing, topics like funding cost and liquidity risks, which have been off the radar screen for a long while, are becoming increasingly important and likely to shape business decisions. And we will also likely see stronger competition in the market for deposits, which may further exacerbate funding challenges. And there is a risk that some banks following certain business models might be caught off guard. Against the backdrop of positive performance in 2022 that I've just described, significant banks have planned distributions to shareholders broadly in line with the previous year. Based on the current information, significant banks will this year distribute 51% of their 2022 gross profits. Supervisors have scrutinized banks' forward-looking capital trajectories, as it was announced last year, finding that virtually all of them are compatible with the planned distributions. In a limited number of cases, banks have reduced distribution amounts following the supervisory dialogue, and some banks planning sizable distributions have wisely chosen to stagger different tranches of their planned share buybacks throughout the year to remain flexible in response to macroeconomic developments. I would like now to take a closer look to our main concerns at present and the key supervisory actions that we have taken or plan to take to address them. To facilitate progress where it is needed, the ECB is determined to use all the tools that we have, and when there are qualitative measures that for a long period of time are not leading to the remediation we want to see, we could introduce targeted Pillar 2 capital requirements, enforcement measures and sanctions to ensure that progress is made, also giving clear timelines and clear escalation processes. A key area of focus is business model sustainability. We have seen very few consolidation efforts recently in 2022, in particular in the market, but we have seen also some metrics that indicate progress in the refocusing of business models. Several banks have actively entered into transactions involving the acquisition or sale of business lines to exit poorly performing market segments or to boost their market presence in areas which are core to their business model. In a similar vein, many banks have been developing and starting to execute digital transformation strategies, although there is still a long way to go there, probably. On the whole, while significant banks have stepped up their efforts to cut costs and refocus their business models, the results have not yet been tangible enough to meaningfully improve their SREP scores for business model. The supervisory assessment, particularly in relation to business models, is echoed by markets, as shown in this chart that shows that there is a high correlation between the scores and the price-to-book ratios. The market valuation of most listed banks under our supervision are still well below the book values, although there has been a significant increase, honestly. They were around slightly below 60% at the beginning of October, and we look back at that last Friday, they were around, the average was around slightly below 80%. So there has been a significant improvement, but still, let's say, still below book value, which means that in terms of the ability to earn the cost of equity, there is still a little way to go. Now, two areas beset by continued weaknesses are internal governance and risk management, as already mentioned. We have numerous findings in this area, especially on the effectiveness of management bodies. Almost half of the supervised banks were subject to at least one measure concerning their management body. The composition is often inadequate, especially in terms of their IT experience and independence of the board members. In most supervised banks, also the management bodies are still insufficiently diverse. And there is also a focus that we have put for some time now on the ability or lack of ability of the board to really challenge the executive and steer the strategy of the bank. Risk data aggregation and reporting was the worst rated subcategory of internal governance in the last year's cycle. We know from the financial crisis that the inability to have proper data to support risk management is a significant weakness in terms of the sustainability of the business model and the ability especially to react to financial headwinds. So there has been standards issued by the Basel Committee 10 years ago. We did a targeted review 7 years ago with recommendations, with supervisory recommendations to the banks, and the progress has not been there. So that's time for us, I think, to escalate supervisory action in this area. Improvements in asset quality led to a slight uptick in the average SREP scores for credit risk. However, the scores remained unchanged for more than half of the supervised banks, owing also to the uncertain macroeconomic environment and signs of latent credit risk, as I mentioned before. These persistent weaknesses resulted in credit risk being the second highest share taking the second highest share of supervisory measures after internal governance. The continued fall in NPEs comes on the back of the supervisory expectations that the ECB put forward in terms of provisioning or coverage of these NPEs. And these Pillar 2 add-ons were applied last year to 24 banks. Some banks reversed the capital deductions that they had previously applied to cover the credit risks arising from NPEs, thus increasing the shortfall and accepting that the Pillar 2 requirement add-on measure would be imposed. That probably also because they prefer to benefit from the different quality of capital that you need to use to fulfill the Pillar 2 requirements rather than fully covering or deducting the amounts. From the supervisory point of view, of course, we strongly encourage all banks to cover NPE with provisions or capital deductions and expect the need to apply a Pillar 2 add-on only in a limited number of cases where, for well-justified reasons, sufficient coverage cannot be achieved. In 2022, leveraged finance was also an area where the ECB decided to escalate its supervisory intervention to address concerning signs of risk build-up, as well as protracted attitude of complacency on the part of banks. Back in 2017, we issued this guidance to banks, and we have not seen an appropriate response on the side of the industry. Origination of high leverage transactions kept increasing and underwriting standards deteriorated further. Therefore, last year we provided banks with detailed expectations regarding the setup of their internal risk appetite framework for leverage transactions, and for the few banks which have very high exposures or weaknesses in their risk controls, specific weaknesses in their risk controls for this line of business, in the 2022 cycle we introduced a targeted capital add-on in their Pillar 2 requirements. Now, in the following slide, we have, let's say, a reminder of a number of thematic work that we conducted and whose results were factored into the SREP assessments and letters. This is work mainly related, I would say, with the challenges raised by the normalization of interest rates. So we have work on commercial real estate we have done, work on residential real estate, started on the same path. We have done a specific review on interest rate and credit spread risks in the banking book, on which we communicated already, identifying this issue of the lack of attention by banks on the economic value of equity perspective and on the tendency of some banks to imprudently reduce their use of fair value accounting in times of financial market turmoil. We have done work on counterparty credit risk, which is particularly related to the risks arising from exposures to non-bank financial institutions, and chiming with our focus on governance. Also, we still have ongoing a review on the composition and effectiveness of banks' management boards. As part of the 2021 SREP cycle, we have already indicated that to safeguard the viability of business models and stay abreast of the development of risks, banks would need to urgently tackle two main structural challenges: digitalization and climate change. And these remain, and will remain probably for a while, at the focus of our attention. And the Russian war against Ukraine has only heightened the pressing need to address these two issues in a strategic and comprehensive manner. The risk of cyber attacks has increased further in the current environment, having already grown during the pandemic, and now more than ever, banks need to tackle structural deficiency in their outsourcing policies and in their IT security and cyber resilience frameworks. Most banks' digital projects are aimed at attracting customers, retaining customers, improving cost efficiency. However, we noticed that the size of the bank's investments remains limited, around 2.8% of their operating income, net operating income. And so we plan to monitor now, we have a number of projects trying to monitor the adoption of a digital transformation agenda by banks, looking, of course, also very much on the risk profile. That's our business. And we will report on the outcomes of these strands of work at the beginning of, in the next cycle. As Europe diversifies away from Russian oil and gas, transition risks are increasing, and these and growing physical risks demand a proactive and comprehensive response from banks. They need to identify, assess, and manage their climate-related and environmental risks, and transparently and truthfully disclose their exposures to these risks. In 2022, we did a lot of work in this area. We did a thematic review. We did the first climate stress test, and all the results were factored into the SREP process. More than 30 significant banks have received over 40 qualitative measures on climate and environmental risks as part of the SREP. And for a small number of banks, the assessment also translated into a deterioration of the SREP scores, without, in this specific cycle, translating into an overall higher capital requirement. The SREP measures for climate and environmental risk were mostly issued in the areas of governance and business models, targeting bank strategic and operational plans, an indication that supervisors view planning as crucial tool for better risk management in this field. In an effort to increase the effectiveness of our supervisory action, we provided banks with a clear timeline for remedial action, requiring them to submit a materiality assessment of climate and environmental risks and their updated operational plans, together with an adequate quantitative monitoring and risk appetite framework by the end of 2023, and the deadline for full compliance with our expectations is set at the end of 2024. Climate change and digital transformation, as I mentioned, will certainly remain amongst our supervisory priorities, as will the functioning of banks' management bodies. As I mentioned before, to further improve banks' governance, we intend to escalate supervisory action on risk data aggregation and reporting, and we will complement our quite, let's say, significant work in the area of credit risk with a higher focus on liquidity and funding risk. As we reach a more mature stage for our organization, we are not only working to ensure that banks remain resilient to shocks, we are also trying to make our supervisory interventions more effective and enforceable for long-lasting unresolved issues affecting the banks, and we intend to apply also the same rigor to the evaluation of our internal processes as we do to our supervision of banks, with the aim of becoming more efficient, agile, and impactful as a supervisor. Several initiatives are ongoing. We are asking our supervisors to apply a supervisory risk tolerance framework, as we ask the banks to have a risk tolerance framework. This will enable them to increase the focus on bank-specific needs, deprioritizing parts of the comprehensive supervisory manual, and prioritization will also apply to the time element of our assessment, as the SREP will start turning into a multi-year process. So that some modules could be, dropped 1 year and pursued the following one and make the process more focused and maybe also lighter. Meanwhile, while we also strive to further improve the clarity of our SREP and other supervisory communications, we also want to continue to increase transparency over our methodologies. These and other aspects of the supervisory process may also benefit from the external advice that we have sought from a group of high-level international experts. They will deliver their report in a little bit more than 1 month, and we will report back on this feedback and on how this transformation process will proceed. So thank you very much for your attention, and we turn now to you. I'm now eager to hear your questions. Thank you.
Thank you very much, Andrea. So we come to your questions now. We have a few questions online already, and I think one in the room. When you are called online, please turn on your camera, and then your sound will come on, and you can ask a question. But we'll go to the first question, I think, here in the room by, yes, Eddie Comfort on Bloomberg, please.
Hi, thank you very much. I have 2 questions, if I may. The first one is on counterparty credit risk. You've mentioned this a couple of times as being something a point of attention. Is it something which could be escalated from a point of attention to something which turns into the next leverage loans, where you actually have capital add-ons and a bit of a fight on your hands with the industry? That's my first. And then the second is, this is your last year as chair of the Supervisory Board, Mr. Enria. Last year you had a bit of a big bang in terms of getting the Basel Committee to recognize the euro area as a single jurisdiction. You must have been pretty happy about that. Do you have another big bang planned for this year? Maybe the first cross-border liquidity waiver granted or actually requested, or something else along those lines? Maybe you want to take a chance to tell us what your key deliverable this year is. Thank you.
Well, thank you for your question. On the counterparty credit risk, yes, it has been an area of focus, definitely. We've done a quite in-depth thematic review. We reported, I did a blog post in January reporting on the results. Indeed, there are several, weaknesses that we identified in the risk management frameworks. Let's say in terms of the onboarding processes, the monitoring, especially I think that when you talk of exposures to non-bank financial institutions, we realize that banks sometimes during the process, that maybe even the banks that do a proper onboarding of customers, sometimes they lose track of the actual concentration of portfolios of these counterparts and of the actual leverage of these counterparts are taking in their day-to-day business. So we gave a number of indications to banks on a one-to-one basis, and we expect this to be remedied pretty fast, honestly. And again, I mean, this is part of the normal SREP process. We are not launching ad hoc targeted, Pillar 2 add-ons. But of course, if some shortfalls are not remedied within a certain time frame, then capital add-ons could be part of the intervention from our side. But I don't expect, let's say, major confrontation. I think it's also in the interest of the industry to tackle this issue. We'll see how damaging it could be. On the last year, let's say, we will do the wrapping up towards the end of the year. I think it's a little bit early. On the point you mentioned specifically, I think that, let's say, there are a number of areas in which I'm very pleased with the progress that we achieved. One in which I honestly ranked pretty high when I started my mandate, and which I'm disappointed, is indeed the area of integration that we have achieved in the banking union. If I look at what we have done, in terms of messages, in terms of communication, on mergers, on waivers, on the possibility to use more the instrument of branches, I think that we put all the instruments on the table. I think it's also up to the industry a little bit to, take them up and develop them. I must say that with the price to book where they have been so far, honestly, expecting banks to focus on growing the business, and especially growing the business on a cross-border basis, was maybe a little bit too much. But now that the situation gets a bit rosier, let's hope we don't have another shock this year, I think that we could see also something more in terms of cross-border developments. But maybe not during my mandate.
Thank you very much. We'll go to the next question online. Francesco Canepa of Reuters. Francesco, can you beam yourself in, please?
Yep. Good morning, everyone. Good morning, Mr. Enria. My question was going to be about internal models. How happy are you with banks' internal models at present, and how far are they from, in general, and if they're are they from complying with?
Francesco, we're losing you a little bit. I don't know. Can you hear us? We lost a little bit the last.
I can hear you.
Oh, okay. Can you try to repeat the question? Shorter, maybe.
Yeah. My question is just about internal models. How happy is the ECB with banks' internal models? Do they need adjusting?
Well, let's say we have done, as you know, a very long process of review of banks' internal models, the so-called TRIM, the targeted review of internal models. We've had a number of findings, and we keep following up. Now, let's say there are regular on-site investigations by our teams on internal models, and when we go, frequently we find issues to be adjusted. There isn't really a sort of generalized dissatisfaction. There are issues in individual banks that need to be fixed from time to time, so nothing, I would say more business as usual in the area of internal models. One point on which we raised attention from banks is that the internal model landscapes is pretty complex. So there are, I can't remember how many models we have, but more than 3,000 for sure. Some banks have internal models that cover very small portfolios for which there is only a marginal impact, and the amount of attention that needs to be given to these models from the supervisors and from the banks is probably disproportionate. So we have launched an initiative to simplify the internal model landscape. Now that also we move to the implementation of the final Basel package, I think that also the the benefits now from the use of internal models is going to be more contained with the output floor. So we expect to see more simplification in the model landscape, but in general, let's say, business as usual. We do have a bottleneck. Several banks are complaining because following TRIM and following the EBA guidelines, banks need to make a lot of adjustments to their models, so we are unable to follow up as fast as we would like because of resource bottlenecks. So everybody needs to be patient. We will have to take a little bit longer than we would like to deal with all the issues which are requiring our attention. Thank you.
Thank you. We'll go back to the room now. The next question goes to Yasmin Osman of the Handelsblatt, please.
Thank you. One question is more to Mr. Elderson. It's if ESG deficiencies or deficiencies in the processes and risk management of ESG caused any SREP add-on to the banks in the cycle now. And Mr. Enria, the Pillar 2 guidance of banks is still not published. Is there any initiative or a plan to change that, to give more transparency? Thank you.
Thank you very much, and good morning from our side as well. On ESG, a little bit more generally, and then I get to your point. Maybe it's good to point out that we have, you know, a medium-term strategy that we follow quite closely. Publishing our supervisory expectations at the end of 2020, asking banks to do self-assessments in 2021, asking banks to do action plans. Then last year, as the chair has explained, the bottom-up stress test, the thematic review, and then this year we have set, and the chair referred to this as well, interim deadlines by the end of March, by the end of this year, leading up to a full compliance with all our expectations by the end of 2024. So I think that is the, you know, the strategy that we are following. The thematic review and the stress test have led to a number of findings. They have been integrated in the SREP process on a bank-by-bank basis. This can lead to effects in the scores, and then I think, as the chair has said, in this cycle, this has not led to a you know, to banks having higher overall capital requirements, but that could of course be different in the years to come. Thank you.
And with reference to the Pillar 2 guidance, there are at the moment no plans to publish it. Of course, there is guidance from ESMA that has said that in certain conditions it could be an obligation for listed banks to publish it, and in some countries actually it is published. I personally would have a preference to publish it, honestly, but I also understand the fact that some supervisors and some banks also fear that if you publish the guidance, instead of being a buffer available for use, it could be perceived by markets as a hardwire minimum, no? And therefore, you know, lose its role as a usable buffer. So this is a little bit the term of the debate. But for the moment being, no publication is foreseen. We have, however, given last year already, 2 years ago actually, in 2021, a disclosure on how we determine the guidance. So in terms of buckets, so this should give at least clarity on the drivers and the ballpark figures.
Thank you very much. So we'll go back to the WebEx, and the next question goes to Francesco Ninfole of Milano Finanza. Francesco, please.
Thank you. Good morning. My first question is on loan volumes. Do you expect a decline or a slowdown in loan volumes, considering also that monetary policy is now restrictive, unlike the pandemic phase? We have seen negative signs from the bank lending survey in this sense. My second question is on the 24 banks that fell short of ECB expectation on NPLs. Could you tell us more? Were you surprised? Should they increase their coverage by a lot? Thank you.
Thank you. Well, on the loan volumes, you know, the information you refer to, you know, the results of the bank lending survey, which has been published last week, I think it was, are indeed signaling a quite important reduction in volumes and the tightening of lending standards. There is also a a sharp decrease in demand. I mean, it has been particularly striking, the indication of demand for mortgages, in some countries, in France, in Germany, having a relative tightening very significant, more than 90% according to the metrics in the bank lending survey. So there is indeed, as a normal outcome of a very steady and fast normalization of monetary policy, the bank lending channel is working as expected. In terms of impact on the bank's balance sheets and profitability, this would of course reduce a little bit the volume effect on the net interest income. But let's say overall, the expectations that I mentioned of analyst banks and also according to our models, in the baseline scenario, in which we avoid the recession or we stay in a very shallow and short recession, is still that the effect on the margins will still be very powerful, and the effect on overall profitability should be positive. Of course, in adverse scenarios, things can change quite significantly. On the 24 banks short of expectations, were we surprised? To be honest, the answer is yes. I mean, I was surprised. We would have expected that banks, seeing our expectations, seeing that there is legislation now in place that for the loans underwritten after 2019 will have the legal obligation to provision or write down according to a certain schedule. I would have expected banks to adjust their their valuations in line with these reference points. We have seen instead last year some banks reversing deductions and instead accepting a higher Pillar 2 requirement. Our reading is that this might be to some extent, as I was mentioning, due to the fact that if you do a deduction, of course, you have a 100% hit on the capital position. If you take a Pillar 2 add-on, you have to have a higher capital requirement that you can fulfill only up to 56% with Common Equity Tier 1 capital, and for the rest also with additional Tier 1 and Tier 2 capital. So the quality of capital impact could be less steep, and also in terms of signaling, you publish a higher capital ratio. But again, as I mentioned, our strong expectation from the supervisory point of view is that banks actually tackle the shortfall in coverage with direct tools, so with provisioning and with deduction. So, but anyway, I mean, that's the framework we are in. This will happen anyway as soon as the new legislation is basically applied to an increasing amount of loans, and the loans originated before 2019, the legacy NPLs, will start disappearing from the balance sheets.
Thank you. We'll go back to the room. The next question goes to Bernd Neubacher of Finanzszene.
Thank you so much for taking my questions. Ms. Enria, you've highlighted the deficiencies in risk data aggregation, and I'd like to know what's the reason for the deficiencies. Is it because of lack of management attention, or is it perhaps more a lack of ability of banks because of problems in their IT, for example? And secondly, I'd like to know, there's been many concerns about cyber attacks from Russia during the Ukraine war. I'd like to know how these attacks have developed. And if I may, perhaps a third question is on the investment of banks in digitalization. It's about, it's not nearly 3% of the operating profits. My question is that enough or sufficient? Thank you so much.
Thank you very much. On the risk data aggregation and reporting, to be honest with you, I might be wrong, but to be honest with you, my impression is that it's not an issue of lack of management attention, is an issue of cost. I mean, tackling these issues, we have sometimes, legacy IT systems which result from sequence of bank mergers. So, I mean, getting to the bottom of it, being able to really integrate IT system and produce, let's say, fast and reliable, accurate data requires heavy investment. And heavy investment today depress the profit today and create positive results in a tomorrow which is to come. So sometimes today's management has not the right incentive to undertake these quite sizable investments. So that's why probably we need to escalate the supervisory pressure to make this happen. As I mentioned, this issue has been raised now for several years, and it is time to have it fixed. Cyber attacks, we noticed an increase in attacks during the pandemic and after the invasion of Russia and Ukraine. The level remained stable at this heightened level compared to the past. To be honest, the level of let's say, of damage, the level of impact of these attacks has not been massive. So there haven't been, major damages caused. But of course, it is an area in which banks need to which banks need to devote a lot of attention. Lessons from the COVID and the war are that, for instance, during the COVID pandemic, we realized that banks that were outsourcing critical functions to India, for instance, there was a moment of great concern, because the COVID pandemic in India was not, it was not clear whether remote working would have been enabling the banks to still have the same functions fulfilled properly. Eventually there was no major, but there was a lot of remediation to be taken fast by the banks. Other cases during the war, there were banks that had IT centers in Russia that were, servicing the group as a whole globally, or which need to scramble, to move the staff out of these IT centers and to ring-fence their own IT centers to avoid contamination of the rest of the group. And there has been a bank that actually defaulted because it was a subsidiary of a Russian bank in the Netherlands, Amsterdam Trade Bank. The parent company went in the sanctions list, and Amazon Web Services, which was the main provider of cloud services, stopped providing services. So the bank was not able to fulfill its function anymore. So this to say that outsourcing becomes really, if you outsource critical IT functions, critical functions of your bank, the way in which you do it could be really, really important for the continuity of services. Investment in digitalization, yes, we think they are a little bit on the low side in terms of the challenge that we have, and the overall amounts, of course, are important, but we think that maybe if we want to have a visible, palpable impact on business models, this is the moment to do it. The pandemic raise awareness on the side of banks that by doing so they can have important improvements on the cost side, on the ability to connect with customers, retain customers, gain new customers. So there is new attention from the commercial point of view. Of course, from our side, there needs to be also attention also on the risk point of view. Thank you.
Thank you very much. We have quite a few questions still lined up, so if I can ask you to keep your questions short and maybe to one, that would be very helpful. Thank you very much. So we're going back to the WebEx. The next question goes to Bjarke Smith-Meyer of Politico. Please.
Hi, Bjarke Smith-Meyer from Politico. Good to see you again, Andrea, even from afar. I will keep it short. You just answered a great question on cyber. So I don't know to what extent the SREP has also looked at some crypto exposure, but I was wondering if there was any analysis of that, if there was anything you could share. And then very finally, there is this idea that we might introduce artificial intelligence into the SREP in the future. I'm just wondering, how would that work? Thanks.
Thank you. I'll try also to be shorter in my answers then. On crypto exposures, the short answer is there aren't many. The size and number of these exposures is pretty contained. We have seen what is now called the crypto winter, no, in 2022, with major defaults and adjustments in that market. The impact on the European banking sector was nihil, basically, so there was no effect. We have seen something in some smaller banks in the US, but nothing really in the European banks. Of course, now with the Basel guidance, which has been approved in December, and which, by the way, was to a large extent driven also by our colleague Rubinian Ibel, we expect that there will be a quite strict and robust, let's say, set of rules guiding the exposure of banks to this sector. In terms of artificial intelligence, it is true, we are using more artificial intelligence in our processes. The objective is to be able to first of all, to reduce, let's say, heavy paper-based type of tasks, like reviewing very thick application packages, using, for instance, natural language processing tools. But we also have projects not to use artificial intelligence to create network analysis of, for instance, interconnections between banks and ownership structures. So there is a lot there. I mean, not yet becoming the backbone of the SREP, but still contributing to a more effective supervisory action on our side. Thank you.
Thank you very much. I'm going to go to a next question on WebEx because he's had his hand up for a while. Vasso Angeletou from Insider in Greece, please. Vasso?
Hello.
Hello.
To update my details, I now work with Capital GR, a website in Greece. So thank you for taking my question. I would like to ask for a Greece-specific issue, the deferred tax credit, and it accounts to over half of the total assets in significant institutions in Greece. So I wonder, Mr. Enria, whether is that an issue of concern for you, and what do you expect from the Greek banks to do to reduce this record high DTC ratio? Thank you.
Thank you. Well, first of all, let me say that deferred tax credits are there for a good reason, no? Because they were created in a very massive process of cleaning of the bank's balance sheet in Greece that has proceeded at very good pace in recent years. No, this, of course, by generating, capital impact, to clean the balance sheets, to sell, securitize non-performing exposures. Banks had also generated these deferred tax credits. Now, it is an issue, of course, that means also that the quality of capital is to a large extent, affected by this type of component. The ECB already gave in an opinion some time ago, I can't remember, a couple of years ago, if I remember well, some indications on how the overall framework, also the regulatory framework, honestly, for DTC could be adjusted to give a better remediation to this problem. I think there is not that much that banks can actually do, so it's more an issue of design of the framework for DTC, I would say. Thank you.
Thank you. Next question goes to the room here, Isabella Bufacchi in the first one. Il Sole 24.
Good morning. Thank you for the opportunity. I have one question on governance, because it is one of your main concerns, and you have imposed qualitative measures. Is it widespread? Are there many banks involved? And are you happy with the way the banks are responding? And do banks understand how you want them to respond to governance issues? Thank you.
Thank you for the question. In the area of governance, as we say, as we've shown also in the charts, is the area where we have most findings and measures. So it's the area where we are raising most issues to many banks, honestly. Let's say, it's a mixed picture. To some extent, I have to acknowledge that several banks have moved. The number of independent in boards has increased. The diversity in boards has increased. The distinction of roles between different, for instance, the issue of executive chairs has been to a large extent remedied, and there is now a better interaction there. So there are a number of areas in which we have seen good progress. But all in all, let's say it is an area in which still we see that the findings remains there for a long period of time. So we think that the banks understand what we want from them, but sometimes it is they are not reacting as fast and decisively as we would expect them to do. So that is one area in which I think we are planning to have a little bit more of escalation process, so setting clear deadlines within a certain time frame. We want this issue to be resolved, and if not, there will be some consequences.
Thank you. So we have 2 questions online and 2 questions in the room. Are you willing to take those? Because we're going a little bit over time, if that's okay. Let's go to the web. The next question is from Frank Siebelt of Reuters. Frank, please.
Yes, hello. Can you hear me?
Yes, we can hear you.
Perfect. I have just one question on the CET1 requirement. I saw that last year only one bank was below its CET1 requirement and guidance versus 6 banks in 2021. Could you explain a little bit what was the development there and what you see at the end of this last year, how it will possibly evolve in the year to come? Thanks a lot.
Thank you. I mean, very, very simple and short answer. We made the buffers, the Pillar 2 buffers, the so-called Pillar 2 guidance, the P2G, available for banks to use, and several banks actually dipped into these buffers and took the opportunity to maybe, clean their balance sheets or make progress, and then raise capital and came back within clear time frames in accordance to plans that they share with their supervisors, came back in line with the requirements. And that's exactly the same in the guidance, and that's exactly what we expect also for the let's say the last bank that was still actually in September below the levels. The chart is a bit maybe misleading because it puts the requirements at the beginning of the year against the level in September of last year, but let's say that's the information we have. So anyway, what we expect, of course, is that all the banks stay above requirements and guidance. And if there were to be, additional tensions, of course, the Pillar 2 guidance, the buffer, is always there to be used. So we are not particularly concerned of the fact that 6 banks during the pandemic dipped in the buffers. Actually, that was useful to some extent to remedy the situation, clean the balance sheets, then raise capital and come back into full compliance.
Thank you very much. We'll go back to the room. Stephen Ahrens from Bloomberg, please.
Yes, thank you. Hi. Just 2 quick questions, if I may. One, a follow-up question on the internal models one. Deutsche Bank has said they're actually delaying a decision on share buybacks because the internal model impact may be pretty big. And Intesa is drawing shedding assets because of the internal model review. I was just wondering if you can tell us if any other banks are expected to see similarly big impacts from this, and just how many banks are undergoing this at the moment. And the second question on counterparty credit risk. I mean, this is driven by Archegos and the big hit, especially Credit Suisse, not your area banks, took from this. And it was pretty much in their prime brokerage. And I was just wondering what business areas and banks they're looking at, mostly prime brokerage, but on the other hand, Archegos was sort of a family office. So are you also looking at wealth management? And how much is fixed income trading also part of this? Because, the products they're selling there are typically not the kind of way you would expect that kind of hit. Okay, thank you.
Thank you. On internal models, let me make this clear. I mean, this is not, there is no strategy here. We are not telling our inspectors, go out there and hammer the banks on internal models, find a way to raise capital requirements. That's not what is happening there. It's business as usual. So we do have banks that, as a result of TRIM or of, the EBA guidance and the new rule, are asking for approval of new models, or we are going there to check the models that they have already in place because sometimes the supervisors are not convinced that the risk density in certain portfolios is in the right place. Our inspectors go there, they have findings, and sometimes these findings are material, and this leads to a request for remediation. And until the models are changed now to remediate these findings, the bank is asked to have a multiplier, for instance, on risk-weighted assets, so that gives some safety, on the level of risk to also ensure level playing field with competitors. I mean, it's not really no strategy. The fact that, as I mentioned, many models need to change now because of the new EBA guidance or the results of our TRIM investigations. This means that there are many inspections, actually much less than there are requested. So we are not able to do them all. No, we are lagging behind, but let's say it's, again, business as usual, no specific strategic objective there. On counterparty credit risk, prime brokerage, we did also a specific investigation there, but it's not only on prime brokerage. It's any time that you have, significant exposures because you take as a counterpart in derivatives business, certain counterparts. For instance, also in the area of commodity trading, we have seen a lot of positions taken by the European banks, and we got a little bit nervous when commodity prices starting, seeing a lot of volatility. There could be, specific transactions dealing with private equity or hedge funds, which are dealing with LBOs, leveraged buyouts. So there could be a variety of business, that could be covered. And again, for us, what is important is to make sure that that the risk management of banks is in the right place.
Thank you. So the last question on WebEx will go to Martin Arnold of the Financial Times. Martin, please.
Hello, Mr. Enria. Thanks for taking my question. So I wanted to ask about Eurozone banks with exposure to Russia in particular, and whether you're happy for the banks to continue to remain with sizable activities in Russia, given the situation on the ground in Ukraine, or are you pushing for them to present plans for exiting and to act on those plans? Thank you.
Well, of course, we are putting all our efforts and pressure to make sure that banks actively manage the risks which are entailed by these exposures, cross-border exposures, direct presence in the country. What we have seen is that many banks have taken action, honestly, in different ways. Some banks exited the market, selling the subsidiary in Russia. The window for doing that has been closing a bit because now the the attitude of the Russian authorities in front of requests from European banks to exit and sell the business has become a little bit more hostile. But many banks have reduced the cross-border business, provisioned significantly for the cross-border business, or started a sort of dual steering, so keeping in their prudential and risk management the Russian subsidiaries separate from the rest of the group. So we are following this closely, and of course, any opportunity for the banks to further reduce or exit from that type of business would be something that we would view favorably from the supervisory perspective.
Thank you very much. So the very last question goes to Markus Frühauf of the Frankfurter Allgemeine Zeitung in the room, please. The microphone. Thank you.
Mr. Enria, how can European banks close the gap to US peers in terms of profitability and stock market value?
Well, I'm not an analyst. Maybe it's not my business to to do that. But what I can say is that what we are seeing right now is that, of course, the negative low interest rate environment was a significant drag for the business model of European banks. So having a normalization of interest rates is already a positive effect. So that was not in their hands to some extent. The areas on which we have focused our attention very much, which are the levers that the banks can pull, has been cost efficiency, strategic steer. We've seen that the banks which have a management and a board which have a better grip on the strategic steer of the bank, being able to exit segments of business which are not profitable and getting a sufficient scale in the areas of business where they have a competitive advantage. These are the banks which have been most successful in closing the gap. And finally, as I mentioned before, also the investment in IT and digitalization are also another important lever. So these are the areas on which we have been, pushing banks to focus their attention.
Thank you very much. Thank you, Mr. Andrea. Thank you, Mr. Elderson, for answering all these questions. Thank you, everybody, for coming in and dialing in. And we are a little bit over time, but thank you for your attention. And we close the press conference here. Have a good day. Bye-bye.
Thank you. Thank you very much.